Good afternoon, good morning, or whichever time you are viewing this clip. Today, we're going to look at taxation. We're going to take some looks at how to apply the wholly and exclusive rule for expenses allowed and expenses that might be disallowed as well. Alright, so we'll look at some little details as we go along. So, first, look at expenses allowed, not offer expenses allowed first criteria. Now, Section 13 of the Act, we will look at we're looking at taxation into folks. Of the Act states that there shall be deducted all disbursements and expenses wholly and exclusively incurred by such persons in acquiring the income. The point here is that there must be income from the source before there can be a deduction. In the case of Alexander versus IT Assessment Committee, the taxpayer borrowed money to buy shares in 5 companies. One of the companies paid a dividend, and the court ruled that only interest on the part of the loan that purchased those shares was an allowable deduction. The circumstances and decision in Thirst versus Commissioner of Income Tax were similar. Namely, the taxpayer was not allowed to deduct interest on money borrowed to buy shares in the years when there was no income from the shares. Again, one of the companies paid a dividend, and the court ruled that only the interest on the part of the loan that purchased those shares was a what? An allowable deduction. This case now, the taxpayer was not allowed to deduct interest on money borrowed to buy shares in the years when there was no income from the shares. A deduction can only be claimed if the source to which it relates has been caught by the charging provisions. This point will be further discussed as we go further, right? Following from these and other decisions, the test of an allowable deduction are: the expense must not be of a capital nature, it must be incurred wholly and exclusively in what? Acquiring the income. Now, in some situations, we look at expenses not of a capital nature now. In some situations, the distinction between capital expenditure and revenue expenditure is not very clear, and the court is called upon to decide. In Valambrosa Rubber Company Limited versus Farmer UK case, the taxpayer company incurred expenditure on this rubber plantation for managing, weeding, and tending the whole estate, although only 1/7 produced what? Rubber. The remainder being in the process of maturing to the rubber producing stage, which takes 7 years. It was held that the expenses for production, as weeding and tending, of the whole estate, including the young rubber trees, were deductible. On the other hand, the expenses of bringing new cultivation into production, that is, clearing and land, purchasing suckers and planting them, were capital expenditure. The decision in Valambrosa was followed in the Guyanese case of IRC versus Roosevelt Estates Limited, in which expenditure incurred to prepare land for cultivation was deemed to be a capital expenditure and therefore not deductible for income tax purposes. In this area of revenue expenditure, the court usually will take note of commercial accounting practice, and although seeing it as relevant, the court does not necessarily follow commercial accounting practice. In Marconi, in Marconi, in the Marconi versus Board of Inland Revenue case, A Trinidadian taxpayer company spent a considerable amount improving premises which it held on a 4-year lease. Revenue said this was capital expenditure and disallowed it. The company brought in expert accountancy opinion, which stated that under generally held commercial accounting principles, the amount so expended would be expensed over the 4-year period of the lease and charged to the profit and loss account, as the taxpayer had done. The Tax Appeal Board of Trinidad and Tobago agreed that accountancy opinion was relevant but rejected it and held that expenditure was of a capital nature. We look at expenses now. Statutory formula. The statutory formula in paragraph 13, one of Jamaica's income tax, says that for the purpose of ascertaining the chargeable income or statutory income, as the case may require, of any person, there shall be deducted all disbursements and expenses wholly and exclusively incurred by such person in acquiring the income. So what? So the expenses that were used to acquire the income are deductible. The Act is specific about the expenses which might be admissible as deduction. In light of this, care must be taken to determine whether expenses were indeed incurred in the operation of the business for the purpose of acquiring income. The accountant or auditor of a trade or business will examine such account as a motor vehicle and entertainment expenses recorded in the books to find if these expenses relate to earning the income. Is the motor vehicle provided for the salesperson used for his private activities also? Did the overseas sales trip include a holiday for the family? Was entertainment charged on the business credit card personal or were the guests who were entertained persons who have subsequently brought in new business? No. These are the questions that the auditor might ask to see whether it was wholly and exclusively used in what? Expense in the earning of revenue. In the UK only, expenses incurred for entertainment of overseas customers is allowable. Jamaica allows entertainment expense for both local and what? Overseas customers, but it must appear to the commissioner to be what? Reasonable. In the case of expenses that are allowable but include some private personal use, the accountant will determine the allocation from the facts or use his best judgment to determine the portion of expenses that are wholly and exclusively for the business and those that are for the what? Taxpayer personally. It must be noted that only expenses which can satisfy the test of being wholly and exclusively incurred in acquiring the income will be allowed for what? Income tax purposes. In the UK case of Strong and Co versus Woodfield, the disputed item was a sum paid by way of damages by a hotel to a customer who had been injured when a chimney fell on his head as a result of negligence by the staff. The court held that it was not part of the business of a hotel to drop chimneys on the heads of its guests. Lord Davis stated in the above case that it is not enough that disbursement is made in the course of or arises out of or is connected with the trade or is made out of the profits of the trade. It must be made for the purpose of what? Earning the profit. Alright, let's go now. So we look at some allowable expenditure now. Now, Section 13 of the Income Tax Act sets out the expenditure that is allowable. Section 15 reinforces this by stating that what is not allowable. Further guidance on some common expense items will follow as well. By Section 13, Paragraph 1, allowable expense disbursements relate to the following expenses incurred in the current income. So these now are what? Allowable expenditure. Interest and money borrowed for capital employed in acquiring the what? Income. Rent paid for land or buildings, allowable expenditure. Repairs of buildings, plant and machinery, or for renewal or repair of any implement or utensil. Bad debts and doubtful debts, they are what? Allowable expenditure again. Capital allowances, rates and taxes paid on real estate from which the income is derived, allowable expenditure again. Insurance premiums on property used to acquire the income on which taxes are payable. Now, just to show that allowable expenditures are those that are deducted from the profit to reduce the profit. Alright, remember that, okay? Ordinary annual superannuation contributions allowable. Contributions to an approved fund by an approved association or member of such association are allowable. Reasonable amount for exhaustion, wear and tear, subject to balancing charge allowable. Payments by deed of covenant for at least 5 consecutive years to University of the West Indies and University of Technology. NIS contributions allowable. Donations not exceeding 1/20th of statutory income to be approved education to approve educational institutions or charities. Business entertainment as approved by the commissioner. Hard contributions, employer contributions, employer emoluments, contributions to a retirement scheme of not more than 20% of chargeable income or 20% of emoluments. Ordinary annual contributions to an approved superannuation fund of not more than 10% of the employee's remuneration. Contributions by ministers of religion out of their stipends to widows and orphans funds operated by their denominations. Contributions under the Pensions Act, the Pensions Act, or the Provident Fund Act. Amounts deducted from the pay of members of constabulary force under any relevant legislation and contributed to any pension or scheme. Amounts qualified for deduction under the Income Tax Act by virtue of the provisions of Employees ESOP, Employees Share Ownership Plan Act. Although not stated in Section 13, employees' contributions to NST and payment of education tax are allowable deductions incurred in the employment of workers. Some of the above expenses will be discussed in the following sections. First one is interest on money borrowed for capital employed. Where a, where a taxpayer borrows money and invests this in the business, then the interest on the amount borrowed is an allowable expense. It would appear that in order to qualify, the loan must add to the what? Capital and should not be a short-term borrowing to ease a tight cash flow situation. Alright, remember that, gentle folks. Please, thank you very much. Alright, before we go any further, this case in Hong Kong, 1997, made the point that interest may be capital or revenue expense. In Wharf Properties Limited versus Commissioner of Inland Revenue, Wharf Properties borrowed money from different sources in order to purchase and develop property into commercial complexes. Total interest of over 343 million paid on the loans in the financial year 98-99 was charged on the expense in WPL's tax computations. WPL was relying on the Section 16 of Hong Kong's Act, which states that in ascertaining the taxable profits of a person, there shall be deducted all outgoing expenses, all outgoings and expenses to the extent to which they are incurred in the production of profits, including interest upon any money borrowed by him for the purpose of producing such profits. The prefix also stated that a payment of interest may be a capital or revenue expense, depending on the purpose of which for which it is paid. In years, in the years in question, the loans were being used for acquiring and creating a capital asset and not for holding it as an income producing investment. Therefore, the interest was expended for a capital purpose. On those grounds, the interest could not be deducted as an expense. So, on these, so on those grounds, the interest could not be deducted as an expense. It follows that in determining whether to charge a profit and loss with the interest payment, the circumstances of a payment must be examined, and each case has to be determined on its what own merits. Next subject to look at now is interest paid and what received. The financial statements at year end will be prepared in accordance with the accruals principle. Therefore, interest earned but not received is brought to account, right? For taxation purposes, interest not received is not taxable and therefore deducted from what? The accounting profit figure. Go again. The financial statements at year end will be prepared in accordance with the accruals principle. Therefore, interest earned but not received is what? Is brought to account. For taxation purposes, interest not received is not taxable and is therefore deducted from the accounting profit figure. Alright? On the 1st of November 2013, Plums Fruits placed 50,000 on fixed deposit at 6%, which is for 90 days. At the year December 31st, December 2013, at the year 31st December 2013, this deposit will have earned 7,500 gross, will be 5,625 net of tax, which will be accrued as income receivable in the accounts. As the deposit does not mature until January 31st, 2014, the interest earned for the 2 months, November, December, is not included for taxation purposes. Right? At the year end 2014, the entire 90 days interest will have been received and it will be included in the tax profit for the year of assessment 2014. So it would not have been received for 2013, but what 2014. All right. The treatment is reversed for interest owed and money borrowed for income producing purposes such as acquisition of fixed assets. At year end, in computing the accounting profit, the interest owed but not paid will be accrued as a what? Current payable. In computing the taxable profit, interest not paid is not an allowable deduction and must be what? Added back to the accounting profit. The following year, when it is paid, it will be an allowable deduction. Rentals, repairs, stabilities, and plant machinery. Rent is an allowable expense when the rented premises are used to produce income. Where only part of the premises is used for the trade, business, or profession, then the rent related to only that part of the premises is an what? Allowable deduction. Repairs to buildings, plant, and machinery are allowable, but if the repairs are so extensive that a new asset has evolved, the amount expended may be considered capital expenditure, in which case it is not an allowable deduction. You can pause the video and look at this. Read through this case for yourself if you so desire, but I won't be going through it. Pause the video, read through the case. Pause the video, read through the cases. 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 Pause the video, read through the cases if you want to. Thank you very much. Now, look at disbursements related to employees, wages and salaries, NIS, HART, NHG contributions, education tax, and a few other employee related expenses are what? Allowable deductions. They have advances and loans to staff. A fairly common practice is that employers make salary and commission advances to employees, which are normally recovered over time. In a few cases, the employer may leave before the full amount is recovered. In a few cases, the employer may leave before the full amount is recovered. So it's a case where you pay the person before they do their work, right? In the Caribbean Sales Limited versus CIT case, the commissioner disallowed such an amount not recovered. An appeal, it was held that in those circumstances where an employer advances commissions or salary to an employee, such advances are included in emoluments when received and taxed. If the employee leaves before such advances can be recovered from the employer's position, these are treated as what? Allowable disbursements in earning the business income. There's a difference between a salary advance and a loan to an employee. If an employer receives a loan from his employer, perhaps to buy a car, subsequently leaves without paying off all of the debt, the bad debt amount is not an allowable expense for the employer. In the books, Central Services Limited versus IRC, Guyana, the court endorsed the commissioner's position that uncollectible loans to employees were not allowable. They are not incurred wholly and exclusively in acquiring the company's income. For taxpayers in the trade, business and professional category, wages and salaries paid to connected persons are allowable deductions provided the commissioner has agreed that the amount is reasonable for the work done. The Hartress Fund was established by Human Employment and Resource Act of 1982. The objectives of the HART include to develop, encourage, monitor, and provide finance for training schemes for employment of trainees, to provide employment opportunities for trainees, and to direct or assist in the placement of persons seeking employment in Jamaica. It also approves and accredits institutions which offer training in technical and vocational subjects and certifies courses in technical and vocational areas. This work is funded by contributions from employers. The rates, terms, and conditions relating to the payment of contributions are to be prescribed by Ministry of Finance by way of regulation subject to affirmative resolution in the House of Representatives. The contributions prescribed under the Act are paid by employers at a rate of 3% of the total gross taxable emoluments of employees. Contributions are not paid by employers whose annual pay bill does not exceed 163,328. An employer who pays emoluments to her trainee under the scheme will be allowed a credit from Hartress of $150 per week per trainee, provided the trainee is receiving appropriate training and employment. Example, total gross taxable emoluments for employees of Pardon Jamaica Limited for November 2014 is 2.2 million. As it was gross taxable emolument for employees, right? Pardon employees 3 hard trainees who receive emoluments. The amount that should be remitted for the month of November to the tax department for Hard contributions would be 64,200. Why? 3% of that 2.2 million is what? 60,000. However, this trainee tax credit of what? 150 times 4, because employ what? 3 hard trainees. 4 times 150 meaning 150 per week, right? Which will give you 4 weeks. The 4% is 4 weeks, and the 3% is what? The 3 trainees, right? The amount deductible that is allowable as an expense in the profit and loss would be what? 64,200. Alright. As we continue, contributions to approved retirement funds. Ordinary and ordinary annual contributions to an approved superannuation scheme in which the contribution is not more than 20% of the remuneration of the employee are allowable deductions. Section 44 provides that in the case of the employed person, if the contributions are not ordinary annual ordinary annual payments, the deduction will not be allowable. If the employer makes a payment which is not an ordinary annual contribution, the commissioner will have to direct whether it should be treated as an expense of the year in which the sum is paid, or if it is to be expensed over a period of not exceeding 10 years. Example: John Brown owns a business that repairs shoes and bags, suitcases. John repairs it. John does not live on the premises. John repairs it. Does not operate an approved superannuation scheme, so it contributes 15,000 per month towards an approved retirement fund with All Island Financial Bank. The payments are usually made from the business account. In the year of 2014, the business had gross receipts of 1.45 million and total expenses of 600,000, which included John's approved retirement fund contribution. In this example, we need to compute his chargeable income and then establish whether or not John can charge all of the payments to the business. Now, we have gross receipts 1.4 million, less expenses 600,000, less 180,000 is 420,000, chargeable is 1.1 million 30,000. Now, as the 180,000 is less than 20% of the chargeable income or his earnings, John will be allowed to deduct all of the payments towards his approved retirement fund. The 180,000 is 15,000 times 12. That give you 180,000, alright? 15,000 times 12. Good. So the 180,000 is less than 20% of the chargeable income or his earnings, meaning less than 20% of the 1.4 million. Okay? If you multiply 0.20 times 1.4 million, you get 290. So the 180 is less than 20% of this. Alright? John will be allowed to deduct all of the payments towards his approved retirement fund. These will be treated as business expenses. If, however, contributions towards John's approved retirement fund were, say, 30,000 per month, which with expenses remaining at 420,000 per annum, and all the payments taken from the business, he would only be allowed a maximum deduction of 206,000, which is 20% of 1,030,000 for the year, not the 360,000 expended. So Once the 20% is of the it is 20% of the one of the net income. Once it is less than 20% of net income, it is okay to use. Alright. Education, payments made by a trader for the purposes of technical education related to the trade or business may be allowed. It is essential that the payments be made for specific employees. Bad debts. A taxpayer's business may be in unfortunate position of being owed collectible sums or may be unable to pay its own debts. These situations are discussed further below. Alright, now debts due to the taxpayer, meaning specific debts that have become bad, that is uncollectible are allowable. Alright, as in debt due to you. Um, the commissioner may require some proof of bad debts, such as the dates incurred, the question of efforts and reasons for considering the debts irrecoverable. A general provision of for bad debts, such as 2% of outstanding receivables, is not allowed. All sums subsequently recovered for debts written off must be treated as what? Receipts for the year in which recovered. Bad debts which are not allowable are cash advances laid out not for the purpose of what? The business. Debts arising from the sale of capital assets. Advances are loans to the principal members, members of their what? Families or staff members. Next category is debts paid by taxpayer. Section 14 of the Act deals with situation where a taxpayer may have incurred a debt for the purpose of his trade, business, or profession and may not have been able to pay the debt. He may make an arrangement with his creditor in which it is agreed that he may pay only a part of the debt or that he may pay none of the debt. In such circumstances, the amount of the debt forgiven should be treated as an income for that period. The same situation applies if the debt becomes statute barred and is no longer legally enforceable. If a taxpayer permanently ceases to carry on his trade, business, or profession at the end of or after the end of a period in which part of all of the debt was forgiven or statute barred, the amount is to be treated as a post cessation receipt and is therefore taxable. Alright. Legal and professional fees now. The general principle is that legal and legal expenses of a revenue nature are allowed as deductions, but the expenses of acquiring capital assets are not allowed. Alright. Unless it's Demarcado and Co Limited versus IT Assessment Committee. A taxpayer company claimed the expenses of the managing director and the company's solicitor who traveled to New York to negotiate an agency agreement for the sale of cement in Jamaica. The expenses of the managing director were allowed as these were incurred in the normal course of the company's trade. The expenses of the solicitor were not an allowable deduction as these were not a normal incident in the conduct of their business. Alright. In the case of Island Revenue versus Issa Nicholas, the question to be decided was whether certain legal expenses were revenue or capital in nature. Nicholas spent $25,000 for legal expense services to resist an application by a foreign corporation to manufacture goods in Trinidad in competition, which Nicholas and the company claimed this as a revenue expense. The Board of Inland Revenue disagreed. The final decision of the court was that as it was likely to produce for a taxpayer an enduring advantage, it was capital expenditure. Allowable legal expenses now. Legal expenses incurred in order to determine taxpayers' tax liability or, or to plead a tax case are not allowable deductions. Alright. Expenses of allowable legal expenses are expenses in respect of debt recovery are allowable. Renewal of what? Tenancy and leases, allowable legal expense. Cost of maintaining the company's goodwill. Cost of defending the title to a capital asset. Cost of protecting the company's assets or reputation. Cost of successfully refuting allegations of breaches of law or agreement. Cost in the defense of employees in execution of their duties. All of those are allowable expenses, right? Allowable legal expenses, that is. Legal expenses not allowable now. Examples of legal expenses not allowable are cost of acquiring fixed assets or capital assets or an enduring advantage, cost in respect of preliminary or formation expenses, expenses in connection with the lease, the issuing of shares and debentures, and the raising of loans and capital, costs in respect of fraud, irregularities, or breaches of the law, expenses in connection with tax. In order to determine whether or not the legal or professional fees are allowable, it is necessary to know the underlying reason for which they are incurred. They are not deductible in their own right as expenses of a class or type for which deduction is per is permitted. To be we're gonna stop right here and continue later on.